Hello everyone, welcome to today's session. Today, I would want us to look at scenario analysis. My name is Dr. Joshua Aura. I teach advanced AFM and I happen to be an author of these books. Wherever you see these books at Savani's Textbook Center, etc., please buy them. They have been very, very nicely written. So today, I would want us to look at this particular question that you're able to see popping up on your screen, Omena Limited, which is a question that is within this particular book, study text, RCM study text. But if you don't have it, you can simply look at your screen there. You'll be able to see that question. So you're told, Omena Limited. Omena Limited. Are you able to see the question? Omena Limited is a firm in the manufacturing industry. The management of this company is considering purchasing a new machine at a cost of 125 million. So the cost of the machine is 125 million. This investment is expected to reduce manufacturing cost by shillings 45 million annually. So the investment is expected to reduce manufacturing cost by shillings 45 million annually. The firm will need to increase its net operating working capital by 12.5 million when the machine is installed, but the required operating working capital will return to the original level when the machine is sold after 5 years. Omena Limited will use a straight line method to depreciate the machines, and it expects to sell the machine at the end of 5 years operating life for shillings 11.5 million. So they're giving us their scrap value. The company pays corporation taxes at the rate of 30% and uses 10% cost of capital to evaluate the projects of this nature. Required, the project's net present value, and then B, the management are unsure about the annual savings in operating costs that will occur with the new machine's acquisition. Management believes that these savings may deviate from their base case value of shillings 45 million by as much as a plus or minus 10%. Determine the net present value of the project under both situations and a comment on the sensitivity of this particular variable. Ladies and gentlemen, this is a straightforward question. Of importance here, the very first thing that has to be looked into so well is, ladies and gentlemen, number one, the issue of WC changes. Working capital being introduced at the beginning of the project and the same working capital being released at the end of working capital. Whenever we see working capital, whenever you see working capital, in this case here, you must always do things. You must add it to the initial cost of the machine. Initial cost of the machine for you to be able to get your initial outlay. Initial outlay. That is number one. And then number two, ladies and gentlemen, because this working capital will be released to us on termination of the project. So in this case here, we must also come and add it to the scrap value. Add it to the scrap value, to ascertain terminal benefits, like that, to ascertain terminal benefits. So let us start with this one. So the initial outlay, what we call IO. The initial outlay, ladies and gentlemen, we are going to look at two things. We will take the cost of the machine. The cost of this machine, if you're able to see that question there, the cost of the machine, if you're able to see the question, the cost of the machine is 125 million. Plus now this machine cannot operate themselves. We need some working capital investment. For instance, we need to put in some few inventories. We need to tie some money as a result of what here this machine. And they have told us that the working capital, if you're able to see that question, the working capital, ladies and gentlemen, which has to be introduced is 12.5. So could you kindly combine the two using your good calculator We have here 125. We have 125 plus 12.5. What are we getting there? We are getting there 137.5 like that. And then come and add this. So come and, ladies and gentlemen, ascertain what we call the terminal benefit. The terminal benefit when we terminate this particular project. What are we going to get at the end of the day? Number one, we shall get what we call the scrap value. We shall sell this as scrap metal and realize the scrap value, which this examiner, if you're able to see the question, this examiner has told us it will be 11.5 million. On paragraph number 3. On paragraph number 3, you'll be able to see, ladies and gentlemen, that this particular machine will be sold out upon termination at 11.5. And then the good thing is that we are going to receive working capital back. Working capital, which in this case here shall be released, to us. The working capital that shall be released to us, the working capital which will be released to us is the same figure of 12.5. So in short, ladies and gentlemen, our terminal cash flows will be 11.5 plus 12.5. Always try to use your calculators. So we have here 11.5 plus 12.5, giving us what figure? Giving us a figure of 24 like that. Now, ladies and gentlemen, once we have these particular parameters, what we need to do now, I've been able to ascertain the cash flow at the beginning. I've been able to ascertain the cash flow at the end. Now we need these middle cash flows, what we call operating cash flows. Cash flows are arising out of what year operations. So we need the operating cash flows. So operating cash flows, what do we have there? So these figures, I need to store these figures somewhere. So in this case here, I need to store these figures somewhere here. I have to mention them as a note. I know what the IO is. I know IO is 137.5, and I know my terminal cash flows. My terminal cash flows, ladies and gentlemen, are 20 what year? 24. I hope that is okay with you. My terminal cash flows are 24. My terminal cash flows amount to 24 like that. Now let us look for the operational cash flows. So operational cash flows, what do we have over there? Operational cash flows, ladies and gentlemen. My operational cash flows are very interesting. They have given me that this machine, once the machine comes, we are going to have some savings. So we have savings, ladies and gentlemen, over how much? They have told us, please look at that question. Look at that question. Look at the question. Look at the question. They have told us, ladies and gentlemen, that if you read from the beginning, Omena Limited is a firm in the manufacturing industry. The management of this company is considering purchasing a new machine at a cost of 125 million. The investment is expected to reduce manufacturing cost by 45 million annually. So these savings, ladies and gentlemen, of course, will boost what we call our profit before depreciation and what year? Tax. Our profit before depreciation and tax will amount to 45 million. That is our profit before depreciation and taxation. Whenever we save, we boost our profitability like that. So then because taxation has been given, come and less here depreciation, because tax element has been given. Whenever you see taxation being given, then depreciation becomes relevant. So less depreciation here we shall use, ladies and gentlemen, we shall use straight line method. Straight line method, our cost of the equipment is 125 minus the scrap value, which is 11.5. Scrap value is given in the question as 11.5. So I hope my cameraman is able to change screens. When I'm writing, students should be able to see this. So we have here 125 minus 11.5. Divide this by the question now. Number of years. We are talking of after 5 years. The machine, ladies and gentlemen, has got 5 years. So divide by what year? Divide by 5. So, ladies and gentlemen, if that is the case, what do we have here? We have 125 minus 11.5 equals, divide this by 5, which will end up giving me 22 like that. So you subtract. So we have 45 minus 22.7, which will end up giving me 22.3. So what name do I give to this? This is my profit here before taxation. Once I get profits before tax, I'll come and less what here? I less tax. The tax parameter, which has been given in the question, ladies and gentlemen, is 30%. So less tax. The tax figure given in the question is 30%. The tax figure given in the question is 30%. I hope my students are able to see before required. Before required, the rate of taxation given there is 30%. So at 30%, so we have 22.7, times 0.3, which at the end of the day will give us 6.69. So we have here 6.69. Come and subtract. If you do that, we'll be able to get what we call profit after taxation. So profit after tax, ladies and gentlemen, will be 22.3. 22.3 minus answer, which will end up giving me 15.61. 15.61 is what we call profit after tax. Having gotten profit after tax, I should be able to know how to change this to a cash flow. How do I change this to a cash flow? Basically by adding back depreciation. So come and do the last thing here, which will be to add back depreciation. Add back depreciation over how much here? Depreciation of 22.7. So 22.7 plus 22.7 plus this 15.61 gives me 38.31. 38.31. 38.31. So once I have this 38.31, I reckon the fact that I have my operational cash flow. My operational cash flow is 38.31. It's 38.31. Now the next thing will be for me to discount. Now I can see that I have my annuity. Remember this savings here was an annual figure. I have my annuity here, my cash flow annuity every year as we operate. We have the annuity. And then number two, the other cash flow that I have is this terminal cash flow, which is a lump sum amount, which will come to us at the end of the 5th year. So meaning that I need some two discounting factors. I need some two discounting factors. The first discounting factor that I would need is called the PV for the, or rather you can even start with PV. PV for the annuity. If you look at the question, ladies and gentlemen, what are you able to see for your PV? What are you able to see for your PV? Ladies and gentlemen, they have given us 10% cost of capital. The cost of capital in the question is 10%. Then what I need to do very fast, ladies and gentlemen, with that 10%, I need to go to our present value interest factor tables. We read from there, 10%, 10%, 5 years. So we need here PV, 10%, 10% for 5 years. Read from the tables. But normally what I tell my senior section 5 students is that the examiner rarely will give you a percentage which is found in your table rarely. So in this case here, we must know how to cram the formula. The formula is 1 plus r raised to negative n. 1 plus r raised to negative n is a formula of getting the discounting factors for lump sum amount or irregular amount, PV, present value interest factor. Therefore, this will be 1 plus 0.1 because r is 10%. Raised to how many years? 5 years. So give us a calculator. With a calculator, what we have, my great friends here, with a calculator, what we shall have will be 1.1 raised to negative 5 equals, I'm able to see a figure of 0.62, 0.6209 like that. And then number 2, we have our PV for the annuity. This is an annuity cash flow. So PV for still the same parameters, but now remember the PV formula. It's normally gotten by taking 1 minus this. So 1 minus 1 plus r raised to negative n, and then everything to be divided by r. That's how we normally get our PV. That's how we normally get our PV. Ladies and gentlemen, listen and listen to me very well. What do we have there? I will come and talk of course, I know this is 1.1. So I'll talk of 1 minus 1.1. 1 minus 1.1 raised to negative 5, you say equals, you divide this by 0.1, which at the end of the day will give us 3.7908. 3.7908. Now, ladies and gentlemen, having gotten those parameters, come and give us our net present value. So how will we be able to get net present value? To get net present value, my great friends, if you are watching this, if you're seeing this, to get our net present value, what I need to do here is to come and take my annuity cash flow, which is 38.31. Because it's an annual cash flow that I will receive every year for 5 years, I'll have to come and multiply it with the PV. Then I have got this terminal cash flow that I expect to receive at the end of the 5th year. At the end of the 5th year, my terminal cash flow is 24, if you can remember this figure. So 24 is not a uniform figure. These are one-off figure. It's a lump sum figure. It can only be multiplied by PV. And then come and subtract our initial outlay. Subtract our initial outlay. Meaning, ladies and gentlemen, that our NPV here will be equal to what? We have 38.31 times the PV figure we have. PV figure we have, it is 3.7908 plus 24 times PV figure, present value interest factor, just like that, times 0.6209 minus the initial outlay that we have here as 137.35. 137.35. So then at the end of the day, what shall we get here, somebody? At the end of the day, what we shall get, ladies and gentlemen, here will be 38.31 times 3.7908 plus 24 times 0.6209 minus 137.5, which in this case here gives us 22.627 net present value. If it's positive, what do? We say that this particular project is viable. This particular project is viable. This particular project is what here is viable. That project, ladies and gentlemen, happens to be viable. And of course, if you have got our textbook, study text, you should be able to get into the solutions area and even follow whatever that we have done with you in a better way, Otherwise, allow me to go to Roman 2 of this question. Allow me to go to Roman 2 of this question. So if my cameraman can display the question to us. So we have part B. Part B. Of course, next time we shall not be displaying these questions, because next time we expect all of us to be having this study text, so that this Mualim will only be making reference to a question in this particular study text. The study text goes for 1500. It goes for 1500. Ladies and gentlemen, come back here. What do we have? If you look at B, they're telling us the firm's management are unsure about the annual savings in operating costs that will occur with the new machine acquisition. The management believes that these savings may deviate from their base case value, shillings 45 million, 45 million, this 45 million here, 45 million there, by as much as a plus or minus 10%. So they want us to determine the net present value of the project under both situations and a comment on the sensitivity of this particular what here variable, of this particular variable. So ladies and gentlemen, what do we have here? So I will start with the best case scenario. The best case scenario for us will be that scenario where our profits now will increase. So best means good for us. So profit, the savings, increasing by 10%. And if that happens, ladies and gentlemen, this is what I will be having. I'll need to come here and calculate here. So the title there is best case scenario, best case scenario. Best case scenario is the title. So we have here best case scenario is the title, where we shall start, ladies and gentlemen, with. So we have here best case scenario. Best case scenario. And the best case scenario, ladies and gentlemen, I will begin with my new profit before division and tax, which will be at 110% because of a best seen. So 110% of the base, 110% of the original figure, which was 45. 110% of the figure that was 45. Remember, they have told us that this base profit of 45 million could either increase by 10% or reduce by 10%. When it reduces, then things are worse for us. But now here we are looking at best. Profit increasing is the best case scenario. So we have 1.1 times 45, which at the end of the day will give us 49.5. Ladies and gentlemen, remember here, this is the only item that will change under the best case scenario. All the other things here will remain the same. For example, here we had our depreciation, which we had computed. So the depreciation here will remain the same at 22.5. So come and take this, you subtract 49.5, you less 22.7, give us a figure, which is 26.8. So whatever you have here is our profit before what year? Before tax. So this is our profit before tax. Once you have profit before tax, what do? Come and less taxation at the rate given, which is 30%. So we have this times 0.3, which will give me 8.04. So here I have 8.04 like that. So we have 26.8 minus answer, which gives us 18, which gives us 18.76. So this is what we call profit after tax, of course, which you must now come and add back depreciation. When you add back depreciation, which is 22.7 that we had obtained even much earlier, come and add depreciation. So plus, we have 22.7. What will I end up getting? I'll end up getting 41.46. 41.46. So now, ladies and gentlemen, I'll come back to my net present value because now I have my operational cash flow. So my net present value here will be, instead of this 38.31, best case scenario gives me a new profit here for the new cash flow of 41.46. The PV will remain the same. The terminal cash flow is not going to change. The only thing that was changing is this operational profits here. So the terminal figure is not changing times the PV, and of course, at the end of the day, the initial outlay is not going to change. So the only figure that we are changing here under the best case scenario is this profit, or rather this cash flow, which will be 41.46. So please give us a figure there, give us a figure there, give us a figure here, give us a figure here. At the end of the day, ladies and gentlemen, with a good calculator, what will I have? At the end of the day, this is what I will have. I will have here answer times 3.7908 plus 24 times 0.6209 minus 137.5, which at the end of the day gives us 34.568 34.568 happens to be our best case net present value. If things work out, that is it. If things work out, that is it. That is it. That is it. Ladies and gentlemen, from there, come and, the examiner spoke of 10% increase, 10% reduction. So the reduction is what gives us the worst case scenario. So I need the worst case scenario. I need the worst case scenario. So come and give us the worst case, give us the worst case scenario. Give us here the worst case scenario. Right there, worst case scenario. So worst case scenario, my great friends, this is when we expect a beating, when we expect things not to work for us, when we expect our profit to go down. So come and give us, ladies and gentlemen, our new profit before dividend and tax. Remember, it's a reduction of 10%. That means that our profits will stand at 90% of where they were. They were at 45. So give us there 90% of 45. So 90%, why 90%? Because 10% is being knocked off. So now we are left with 90%. So 90%, this will be 0.9 times 45, which will end up giving us 40.5. This will give us 40.5. So come and the less depreciation will remain the same. It's only one factor they have told us to stretch and play around with. That is savings. Savings automatically contribute to profits before depreciation and tax. So we have here 40.5 minus 22.7, which at the end of the day, ladies and gentlemen, gives me a PBT quite low of 17.8. 17.8. So this 17.8 come and share the same with the taxman, so times 0.3. So the taxman will take a paltry figure of 5.34. So we have here 17.8 minus answer, which at the end of the day will give me 12.46. So this 12.46 happens to be our what? Our profits after tax. Once you have profit after tax, come and add back depreciation. So when you add back depreciation of 22.7, at the end of the day, we'll get 35 point what here somebody? 35.16. I hope I'm correct. 35.16. And once I have that, ladies and gentlemen, I should be able to give you, great students of mine, my worst case. I should be able to ascertain my worst case NPV. And therefore, the worst case NPV, now I can see my worst case operational cash flows are 35.16. 35.16 multiplied by our PV for will not change. PV for is 3.7908 plus, of course, the terminal cash flow not change because of your profits having changed. So plus 24 times 0.6209 minus 137.5. Now you should be able to give us this worst case scenario. So this worst case scenario net present value, ladies and gentlemen, will be, we have here 35.16 times 3.7908 plus 24 times 0.6209 minus 137.5, which at the end of the day will give us 10.86 net present value. Now, the only thing that you need to do is to come and give us the percentage changes. Now we have got 3 net present values. We have a net present value if the worst happens, and then if the best happens, and then of course we know the base. If you remember very well, or if you have this book, if you have got this book, you'll be able to see our base. Our base was at 22.627. Yeah. So remember our base. Now we're writing together our base case net present value was 22.627. 22.267. So ladies and gentlemen, given this information, I should be able to get the percentage change of best. So percentage change of best, what do I do? I will take the new minus the old, all over the old, times 100. So new minus old, all over the old, times 100. The new, of course, is the best. The new is the best, old will be the base. So the new, what do we have here for the new best? The new best is 34.568 minus the old. Old here is 22.627. All over, again the old, which is 22.627. Whatever we get there, times 100. Whatever we get there, times 100. So then at the end of the day, what do we have here? We have 34.568 minus 22.627 equals divided by 22.627, which at the end of the day gives me 0.5277, which is the same as 52.77 what here? Percentage. So having gotten that, give us also the percentage change, ladies and gentlemen, the percentage change of worst. The percentage change of worst. So the percentage change of worst, what we have there, percentage change of worst, this will be equal to, ladies and gentlemen, we have the new, of course, as usual, minus the old, divided by the old. Whatever we get there times 100. So the new, which is the worst, is 10.68 minus old, ladies and gentlemen, which is the base, which is 22.627 all over 22.627 times 100. So then this one will give us what figure, somebody here? So we have 10.686 minus 22.627 equals divided by 22.627 equals. So at the end of the day, I'm seeing a negative. Of course, here we don't talk of negatives, we ignore them. This again is giving me 52.77 what here percentage, meaning that this is the same as the percentage change of best, percentage change of best, percentage change of best, percentage change of best. Ladies and gentlemen, don't forget that very important concept, that we only talk over our project being very risky. Our project being very risky whenever the percentage of best, whenever the percentage of worst exceeds the percentage of best. If, for example, the worst percentage here was to be like 80, and the percentage of best, for example, is 60, then I would have had a reason to worry. Otherwise, here, because they are identical, we can only say that now we are indifferent. In terms of risk attitude, we call this one here risk neutrality. So for us to consider to look at whether we're going to have to implement this project or not, we have to look at other factors except what here somebody risk. Ladies and gentlemen, remember, we are having a very important offer for you. The offer is, we've done videos for all these subjects called AFM, and they put them in our portal. You only get to pay us 3,400 Kenya shillings. And once you pay us the 3,400 Kenya shillings, ladies and gentlemen, you'll be able to get access to all our pre-recorded videos. That's number one. Number two, ladies and gentlemen, you'll be able to get access to our live classes whenever we have them. You'll not pay for them. And then most importantly, you will be able, ladies and gentlemen, to get our revision kit for free. So that the 400 is giving you so many what here benefits. It's giving you so many benefits. And remember, this particular offer is ending tomorrow. Why don't you seize the opportunity and take advantage of all those great things? Otherwise, thank you very much for having watched this. If you are impressed, please don't fail to hit the share button. God bless you. See you in our next class. Thank you.